Hello and welcome to episode 142 Property Mastermind podcast with Hilary Saxon and Bob Anderson. A bit of a treat this week though with Bob Anderson and Aaron Ralph. So this week, Bob and Aaron are going to be talking about how to develop commercial property developments. And they will be unpacking the different types of commercial property developments that there are. They will also compare commercial with residential, so having a look at how they differ. And lastly, they will break down and talk to you about a case study of a current project we have underway. So you're going to find this episode fantastic. Jump on into episode 142 with Bob Anderson and Aaron Ralph. Hello, before we kick into episode 142 with Bob and Aaron, I just thought I would enlighten you on a couple of things. Number one, we have our free masterclass next Saturday, which is the 6th of April. Starts at 9 a.m, so just check the link below to see what time that is for you. So there is a link below to register, and then when you register, you get the link for that, and it is always a fabulous event, our masterclass, so you are welcome to join us, and it's free. So this Saturday coming, or next Saturday, the 6th of April, depending on when you listen. So get the link and join us for that. The next thing I'd like to let you know about is we do have investment opportunities. One, we have investment opportunities with upcoming industrial developments that we have underway, but we also have other opportunities available. So if you would like to talk to me about perhaps investing with us or what we have coming up, and let's just see if we could perhaps work together, if the numbers and the stars align, well, I can probably help you out there. So feel free to reach out, have a chat with me, admin@propertymastermind.com.au. I'll also put the link below this podcast. Look forward to chatting to you soon. Anyway, you can now jump on into episode 142 with Bob and Aaron.
Hello and welcome to the podcast. As you can see, today, Hilary's not here. That's Aaron. Anyway, I'll talk to you more about Aaron in a moment. Aaron, you're supposed to ask me my tip for the week.
Oh, I was supposed to be doing Hilary's job. So, Bob, what's your tip for the week?
Thanks, Hilary. Thanks, Aaron. Here's a tip. Don't buy cheap umbrellas.
Okay.
It's been extremely windy and wet up here, and somebody gave me a little umbrella the other day to walk from the office down the road, and I think it was one of those $5 cheapy ones. I got about 10 metres, and the thing turned inside out, and all the arms broke, and I ended up saturated. So I think the motto or the tip: buy an umbrella for sure, but buy a good solid one, not the $5 ones. There you go.
So maybe once to buy Mary Poppins.
I nearly took off. Well, it's been very windy and wet where we are, but things are getting better. Yeah, so today's podcast, something a little bit different, as you can see, not just because Aaron's here, and I will introduce you in a moment.
Oh, thanks, mate.
But we're talking about how to develop commercial developments. Now, we always talk about residential because that's what most of us are into. We're going to talk a bit about commercial. But before we do, I will introduce you. So for those of you who don't know Aaron works with Hilary and I in Property Mastermind, and Aaron is a mentor. So used to be a coach, worked his way up in the world. He's a full-blown mentor these days to people in our mentoring program. And so Aaron's got a wealth of experience. And we also do some projects together, Aaron and Hilary and myself, structured projects, which we do. So there you go. Welcome
Cheers,
to the podcast, mate.
Thank you very much.
Yeah,
Good
so
to be here.
commercial property, commercial developments, resi we're used to. And we always talk about residential, we teach residential, and that's because it's familiar to everybody. We live in a house or a unit or a townhouse. We're familiar with it. We may own an investment. We're familiar with it. Generally, it's a low entry level in terms of dollars.
Yep.
But at the moment, we're still doing resi, but we've stepped sideways. And we'll tell you more about it in a moment, about an industrial development we're doing. But Aaron, what types of commercial, keeping it simple, what type of commercial properties or developments are there out there?
Okay, so commercial is quite a broad spectrum, but they're sort of core asset classes. So sort of three of the core asset classes that we talk about are office, retail, and industrial. And then,
Okay. So office, but I think that's pretty obvious, but the scale would vary enormously, wouldn't it?
yeah, absolutely. So, I mean, offices sort of start from anything from renovated houses on
Yeah.
the corner block, and I've used this example before, but you know, remember when I lived in Windsor in Brisbane. I used to visit my dentist, and he had a renovated old Queenslander. I thought that
Yeah.
was pretty cool. But obviously, yeah, they go all the way up to
All the way
your high
up.
rises. Yeah.
Often you see houses around a commercial precinct. I'm thinking of one at the moment. I'm thinking of a big Westfield shopping centre. But the residential streets that are very close to that have houses,
Mm.
and often they're offices for people like maybe accountants or lawyers or those sorts of people. So we're talking anything from a house upwards. And I have developed some pretty big commercial office blocks in the city when I worked for the big boys, for the big development companies. Biggest one I did was 67 stories. So it could be anything from a house to you name it. That's
Mm.
commercial offices. You mentioned retail.
Yes, yeah. So retail, we often think of the big shopping centres, and that tends to be really that space. I mean,
Yeah.
it's certainly not somewhere you want to start. Very specialised knowledge,
Yeah, it is too. And getting the tenancy mix right and all that sort of thing. I mean, retail could be anything sort of from a shop, if you like. Retail to me is where people are selling stuff to the public, I guess. It's a
Mm,
very broad sort of a
it is, yeah,
definition. And it could be, it could be even a corner store. But really, we think of shopping centres and we think of the big ones being Westfield,
yeah, correct.
but
Yep,
also even down to strip shops, the suburban strip, what I call a strip shop.
yep,
So that would be, it could be like 6 shops, it could be 20 shops.
yes,
I
yeah,
had, I
definitely.
had a friend who used to specialise in doing suburban strip shops. So it could be anything from probably eight, 8 to 20,
Okay, yep,
but he only did them if he had an anchor tenant. So,
right, okay, yep.
so you might describe what an anchor tenant is.
Yeah, so an anchor tenant is basically like a much bigger business, so a fairly reputable business,
Mm,
and of course, that's going to bring in your other tenants as well because that's going to bring in a lot of foot traffic. So
yeah.
with retail, we call it retail science basically. So foot
Mm,
traffic is a huge
yeah.
component of that.
Yeah.
You know.
He had a bit of a hookup for a while with IGA,
Okay. Yep.
and they were expanding and looking for opportunities to expand. So he sort of had an anchor tenant in his back pocket.
Yeah.
So it's
Nice.
more
Yep.
a matter of finding sites and then getting that anchor tenant. So the other one you mentioned is industrial, and we're going to talk more about that. And we're going to talk about an industrial project that
Yeah.
we're starting as well. But tell us a bit about industrial.
Industrial. Well, this is the space we love. So, I mean, once again, this is one of those categories like industrial encompasses a huge array of things. But I guess when we sort of mention that, typically the dirty old sheds is what most people think of historically, isn't it? The
Grubby old stuff.
grubby old factories. But I mean, it encompasses everything all the way from sort of, distribution centers to warehouses of all different sizes,
Heavy industry.
heavy industry factories, and what we like to the space we're playing at the moment. Also, what we call these like little strata units.
Yeah.
Yeah,
So it's you could almost call it upmarket industrial in a way
yeah,
because
absolutely.
they look good. They architecturally they look good. They're not the big, 10,000 square meter sheds. Generally smaller, and we'll talk more about that when we do some case study. But that's like I call it the upmarket modern industrial.
Yes, absolutely. And to the point, Bob, that I remember a while ago I sent you some photos, and if you hadn't have known that they were industrial sheds, you would have
Mm,
swore blind they were apartments. I mean, they're,
yeah,
they're to the level of they're so upspec.
yeah,
It's crazy what people are doing at the moment. So yeah,
yeah.
gone are the old heavy, disgusting, very boring sheds.
Well, yeah. I mean, there are areas that are zoned for that heavy industry, that noisy machinery and
Yeah.
big trucks and semis and goodness knows what. But that's not what we're talking about generally. So residential and well, let's just call it commercial and residential. So lots of differences, but let's just pick some of the aspects like rental yield and
Yeah.
cash flows and those sorts of things. So what about yield? Tell me about yield on residential, which most of us know a bit about, but yield on say commercial.
Yeah, so quite a big difference between the yield or the rent coming in. So for residential, like we're talking more gross
Mm,
yield. So what does that mean? Well, that means that all of that money coming in is going to have to account for your expenses as well. So you're going to be paying property management fees and rates and
rates, even
utilities.
potentially land tax.
Yeah, all of
So,
that.
so typical on a, they'd be the main three that over here. I mean, we're not talking about finance because that just depends how you're geared, but certainly, yeah, rates and, as you said, agents commission, potentially land tax on resi. So you might start off with a 4 or 5% gross yield, but if you started off at say 5, you might end up at 3.5 net.
Yeah, absolutely.
after those set expenses, and then of course you've got to deal with your finance depending on how that is. But what about commercial? And we just talked about a whole range of commercial. But if we could generalise, if we're saying resi could be 5 back to 3, and when we know in some places it could be 3 back to 2, but what about commercial?
Yeah, well, this is
On a yield.
Yeah, so in terms of yield, we're typically talking at what we call a net instead of a gross. So we're talking about the money coming in is your rent, and the tenant's going to pay what we call plus outgoing. So your tenant is actually going to pay a lot of those expenses for you. So obviously that yield is going to be a lot higher, and we're looking at sort of positive cash flow when we're looking.
So we could be talking about net yields after expenses of 5 to 8 or 9%, depending on product, where it is, and a whole heap of variables.
Yeah, correct.
So higher income, higher rental, if you like, if you're comparing it to resi.
Yeah, absolutely.
So I guess from a cash flow point of view, and particularly with current interest rates, I mean, they're not 2% anymore. You could be negative geared fairly easily on resi, but less so on commercial.
Yeah, that's correct. I mean, I guess the big thing is with residential, I mean, a lot of people are willing to sort of take the cash flow hit because they're looking for the capital growth.
Yeah.
So they're paying the freight, for the market to sort of pay them back, basically. But commercial is definitely a cash flow play.
Yeah. So we're talking about tenants. We're talking about, let's just look at it as an investment point of view. We might have an industrial unit as an investment. We might have a residential unit as an investment. But the leases, I mean, in resi, like typically, most people like a 12-month lease, let's say, could be 6 to 12. What about the commercial world?
Yeah, so it works a little bit differently. If I use an example, I'll say a 3x3x3. So what I'm talking about there is a 3-year lease with an option to renew it after 3 years for another 3 years, and then an option to renew it again. So in theory,
the option with the tenant.
Yes.
So they perhaps could minimum of 3 years, but if they took up their other options, they could be there for 9 years.
That's right. So in theory, it could be a 9-year lease.
But then it can be a 5 by 5 or a 5 by 5 by 5. I mean, it's not locked in.
No, that's right. It's just an example. I mean, you can have any comment. I mean, childcare is a great example. You could have 15 by 15. They're really long-term leases.
I can remember back in the day when I worked for one of the really big development companies, we took an international tenant on an industrial complex, and they took a 20-year lease on it, just one hit.
Yeah.
Because they wanted to be there for 20 years, they didn't want to move around. And also the fit out we did was quite specific to them. So we wanted a long lease.
Yeah.
Yeah. And as you said before, with the expenses, things like land tax and insurance and those sorts of things, on the commercial, the tenant pays.
Yes. Yeah.
But on resi, the landlord owner pays.
Yeah, that's right. As a landlord, you've got to pay the freight big time.
Yeah. So that's how you end up with a higher net yield.
Yep.
One of the reasons. And so capital growth, we're talking about properties increasing in value. Residentially, we know it's driven by a number of factors. Supply and demand, the number of people in the market. I mean, it's variable. Interest rates have an effect. Inflation has an effect. The macro and micro economics have their effect. Property cycles. Most of us are sort of reasonably familiar with what dictates growth in the resi market. But what's different in the commercial market?
Yeah, so there's actually, and I won't.
How do properties go up? What drives them?
Yeah, it tends to be more the income. So, like I said, I won't go too much into the mathematics, but there is quite a simple equation that you can sort of rearrange, and from the income, you can actually calculate the market value or the purchase price. So,
it's like yield based.
It is yield based. So with the leases, we actually build in a rental increase. So what we can do, once again, over time, and that's usually annually or
Yeah.
per year.
Could be related to CPI or
That's right.
CPI plus margin, or even reviewed to the market every so often.
Well,
So
that's right.
They're
Yeah,
real commercial leases. Yeah.
that's right. So that in itself is going to make the price go up
Okay.
because of that calculation. But there are other factors. Like,
Yeah.
it's not just, sometimes people get it into their heads that it's solely related to the income,
Yeah.
but there are other factors.
The strength of the tenant.
Yeah.
If your tenant was a local panel beater, or it was Sony,
Yeah.
very different tenant. So that comes in at the length of the leases, the strength of the tenant. There's other
Yeah.
factors, but they're all commercially based.
Absolutely.
And they're all built
Yep.
around formulas, whereas, resi market's more, comparable sales, what's happening,
Yes.
those sorts of things. It can be quite local as
Mm.
well. Okay. So we have mentioned that we're just starting an industrial project, and it's for a reason. I mean, we're still doing resi stuff, as you know. Well,
Yep.
we're involved in it as well. And so, industrial, well, it's a bit like diversification, I suppose, not sounding like a financial planner, but, we're involved in residential, we're doing, retirement product, and why not? Why not commercial? Because particularly industrial, we'll talk about that in a moment, it's in a pretty healthy state. So why not just
Yeah.
spread our wings a bit more? And that's, that's what we're doing.
Yeah, absolutely. Yep.
So why industrial? Like, what are the reasons? We've chosen industrial, so we've just put aside, retail, office blocks, those sorts of things. We're going industrial, but what's special about industrial?
Yeah, I mean, industrial is really sort of having its day. Typically, industrial once upon a time was viewed as the more risky asset.
Mm.
So office was sort of your premium type asset, and that's all changing. So things like, for instance, largest transaction volumes. Now, industrial has the largest transaction volumes
over retail and
office.
And office, yeah.
Yep, and I mean, there's also what we call really strong structural demand drivers. And when I say a structural demand driver, I'm talking about the underlying demand for this that creates a real tailwind. So things like e-commerce, I mean, it's massive, I mean, and obviously this sector directly benefits from that.
One of the good things, if you like, or to come out of COVID, with everybody buying online back then.
Well, that's exactly
really
right.
Driven, and it's gone on. It's just continued.
That's exactly right. It's and it's funny if you look at the graphs. You see this massive jump during COVID, and of course it makes sense. Everybody
and a lot of that storage and warehousing and that sort of thing.
Yeah. So I mean, that's just there's a whole array. I won't waste too much time in going into this, but there's a whole lot of things like that. And another thing, just very quickly, is, and I have to say this because I love AI, is the optimization of the logistics is going to benefit greatly. And Bob, I think I mentioned this to you the other day, just on a bit.
You're
of a
always
side
talking about
AI. Just on a side note, I think I mentioned this to you yesterday, Bob, just as some mind-blowing numbers that the AI, where it's at the
moment. Here we go.
So
this could be an hour on AI. Here we go.
In the next 5 years, they reckon that AI is going to be 1,600 times more powerful than it is now in the next 5 years. So anyway, that's just,
so we're talking about
mind-blowing stat.
Yeah. So logistics.
So logistics, and that's going to directly a very strong underlying fundamental driver of this type of product.
And we've seen industrial pretty strong everywhere.
Yes,
around
incredibly
the country.
Low vacancy rates, all the right things. Massive, immigration and net migration, or people coming in. I won't go too much into the how that breakdown of that,
because that'll keep you going for now. Because if you haven't worked it out, Aaron is big on market research. He's big on stats. He's right all into AI. Leading the world, or leading Property Mastermind at least in AI, and so you put a lot in the background.
Yeah, and that's the thing about commercial property, Bob. I think we've it's very analytical, and that's right in my wheelhouse.
And you've got to get it right.
Yeah,
and even down to design.
Yes,
like we spent a bit of time yesterday talking to one of the top commercial agents that we know. In fact, we even went for a bit of a walk around one of the industrial estates. It's done reasonably well. And just looking at two adjoining industrial projects, one was hard to rent, hard to sell. Another one was easy to rent and easy to sell.
Yep.
And comes down a lot to like functionality,
Yeah,
like
completely.
just having the
Yeah.
roller doors a little bit too narrow, not quite high enough.
Yep.
Parking, turning circles, truck access or not. Just lots of little variables that
Mm,
it's those 1%ers that make the difference. And to an
yeah,
extent, that's residential as well, but particularly like you can get hurt if you don't get that right.
that's right. Yeah.
So let's talk a little bit about the project at the moment that we're just starting off.
Yep.
So it's in southeast Queensland, and like a lot of places around Australia, it's really hard to get industrial land to develop. So
Yeah,
you were
incredibly so.
lucky through some of your associations that we snagged a block of land off
Yes.
market
Yep.
before it ever hit the market. How big is it?
4,230 square meters.
Okay, so it's a bit over the acre in the old
Yeah.
parliament, so that's pretty good. And the zoning allows us to do what sort of development? This
Yes.
particular zoning, so it's not heavy industry.
No, it's not general industry. So there's development not far away in a place called Caboolture, for those who aren't familiar, that is what they call general industry. So it is very much your typical sort of, bland concrete sheds, all look fairly similar. But this is
But
this
not
only,
where we're talking.
no. So where we're developing is called MIBA, so it's mixed industry and business. So it allows for other types of, like, potentially retail in there and stuff. So it creates a real mix. So it's really ideal. Because you obviously you don't want, you want that diversity, and it brings
Yeah.
in a different grade of tenant
Yeah,
as well.
and the buildings look very
Yeah,
different.
and they look
as you
very
said.
different. Yep.
So we've done some initial schematics, but it could change. So at the
Yep.
moment, we've done one up, which I'll call them sheds for the sake of it, the name. They
Smart
don't look
sheds.
anything like sheds. They look, could even get, as you said, can even look a little bit residential.
Yep.
So we're 12 there. It's driven a lot by parking
Yes.
as well. But what size sheds are we talking about at the moment? And this could vary a little bit. But
Yeah, it can vary, but we're probably at this stage looking from 120 square meters all the way up to sort of 350.
okay, so not the big mid-range, not the 5s and
No,
600s.
that's right. Yeah.
Or of course, we probably, if we did one big shed on that, what could we do? We're not going to do one big shed, but it could be like a 2,500 square meter shed, or
big distribution
something
center or
like
something like that, big warehouse.
I knew if there is a big distributor out there who wants a big shed on 4,000, we're happy to build it for you if you want to sign a long lease. So the project itself, look, how long from the time, let's say, because with this one, we're able to, we've got a settlements down the track.
Yeah.
So that means we can start and get a fair way down with our development permit before we settle. So that's a bonus. But once we hit the ground running, how long a project is it, like, to get, say, the rest of the development permit, the building permit, obviously get it built?
Yeah. So
to building, is it a year up, a year in?
About 10 months for the build.
Yeah.
Yeah, because these are quite, they're quite simple. It's what they call tilt slab construction. So basically, it's a lot of prefab concrete, and they basically lift up a bunch of walls and tack them together. I'm sure it's a bit more complicated than that.
I'm sure industrial builders who do those would be insulted by that, but it's true. I mean, compared to resi, with all the plumbing we do and the tiling and everything else, that's really expensive. So obviously, square meter rates are a fair bit less than resi. So we're talking, let's say, a little bit of approval to go once we settle, and building probably be 12 months in. We might look at some pre-letting, pre-sales along the way.
Yep.
And then there's a lease down and a sell down period after that.
Yeah.
Like, let's just be really conservative and say it's probably a 2-year project. That'd be fair to say.
Yeah.
Well, I know plenty of people that are doing a duplex at the moment, and it's a 2-year.
Well, that's right.
Project.
That's exactly right.
With some councils, but then others are a lot quicker, and it can be a lot quicker. So the development permit is the thing that can be quick or not quick. So okay, so it's basically a 2-year project. So from a finance point of view, because most of us are familiar with how resi works, is it much different?
Well, I mean, it is a bit different. So typically, I guess what we're looking at is either a 65% of your GRV or what you can sell it for.
So GRV, gross realisation value, that's the end value. If this was 12 sheds, let's say, it's what we could sell those for when they're complete.
Yes.
GRV.
Yeah.
And it can be a percentage of that.
But sort of what we find with the residential space, a lot of times they will cap the that 75% of your total development costs.
Yeah, so it's a bit of a, we'll lend you 65% of the GRV, or let's say 75% of your costs, whichever is the lesser. And when you got sort of returns on costs for around sort of 18%, they're almost the same number.
Yeah. And that's, like exactly. As that comes down, it tends to be the TDC that chokes you out, isn't it?
Yeah, one of them's going to choke you out, as you put it. But we've already looked at the finance side of this, obviously. So we're talking about a finance you might lend 65% of GRV. But are you suggesting they're not so much looking at the percentage of the costs?
Well, that's exactly right. So they're not going to worry about the TDC, and because our return on costs is quite significantly higher than residential.
Okay, so you've raised that question.
Yeah.
Return on cost, your profit as a percentage of your total cost. We look at that all the time as developers. It's one of the parameters that financiers look at. And let's just say, if you can find a good duplex site at the moment, 15%, maybe doing some townhouses, 18% return on cost. And they're all good. They're good doable deals. They're profitable. You do well out of those. What are we talking about on this project as a return on cost?
Yeah, so around it's just over 25%, getting close to 26%. So we're north of 25% on these
north of 25% based on the current feasibilities. And with the feasibilities that we run, I mean, we both looked on them. I'd have to call it conservative.
Yeah, absolutely. So and this is very important, I guess, with using agents too. We often talk about, even in residential, obviously you want to have the best consultants, but it's even more critical in this space. And very early on, we decided on the agents that we're going to use, and kind of, Bob, that reminds me actually of yesterday having a chat to the agent, and this is how critical this is. He even brought up the fact of another group that he was dealing with that sort of brought him on halfway through their project after they designed.
Bit of an advisor.
That's right. And basically he took a look at the plans and they'd missed some quite major things in their design. Yeah. So they had to go back and
that's an expensive business in dollars, having to go back and redesign stuff that's already been designed, plus time, and time's money.
Yep.
And just getting it wrong. So we made the call to do it early.
Absolutely. Yeah, right from the get-go and every step of the way to do that. So, so having an agent.
I think with any type of development at all, you need to understand right early in the piece who is going to be buying this property at the other end and what are their expectations.
Yes.
And build accordingly. And we've done it here again.
Yeah.
We've consulted the experts early about design, functionality, shed sizes. We've looked at competition that could be coming up and see how that, a bit of a SWOT analysis almost,
Yeah.
Commercial's almost like doing a business plan.
It is.
In comparison to, say, residential. So many aspects that you look at. And so what's the profit running on a very conservative feasibility at the moment?
Yeah, so the profit, I think, is about 1.9 on this one. So
about 1.9 on it. It'll crack too easy.
Yeah. So getting back to that point about the conservative figures, like for instance, it's a little bit different. In residential, we're generally working off like
comparable sales
and units, but we actually work off square meter rates in residential.
It's very mathematical and analytical. Commercial real estate as an investment, but also as a development, because as a developer, we can't ignore the investment. So who's going to buy these?
So
because this is a develop and sell. We're not holding any of these.
Yeah, correct.
Next project we might hold some.
Yeah,
but this one will sell them also.
So there's quite a few. There's quite a few people at like tradies for one. There's a big market for the tradies in this particular area. Construction is the third biggest industry. So
like resi, it could be an owner occupier or it could be an investor who's going to buy these products.
Yep.
Owner occupier, they're going to be a business owner
Yep.
who wants to operate out of there.
Yep.
And I mean, they might even buy it in their self-managed super fund, which often happens.
Yep.
It's a bit different from resi. You can't normally buy a residential property in your self-managed super fund and live in it, but you can buy a commercial property in your self-managed super fund and work out of it. And it's sort of like you're the tenant and the owner.
Yes.
I've done that. It's an interesting thing when you're paying yourself rent every month. So owner occupiers, we understand that people are going to operate their own businesses. Selling to an investor, so it could be a vacant shed or it could be with a tenant.
That's correct.
They prefer a tenant, obviously.
Yep.
With a decent lease, good tenant, good lease. But it's a little bit different. How does that work?
Yeah, so once you have managed to lease it out, then we call it selling as a going concern.
Okay.
So it's just a fancy term for basically saying you're selling it with already pre-leased.
Yeah.
But there are tax advantages to that. So
GST being
GST is the big one. So basically, we're
different from resi.
That's right. Yeah. So treated differently.
Yeah. So a good conversation with a good accountant as well, just to get the tax angles right.
Yeah, for sure.
So we'll be selling to owner occupiers this project. We'll also be selling to investors, and that's why we'll be looking at leasing.
Yes.
Pre-leasing before completion.
Yep, and that gets back to that multiple exit strategy. So we, and that was, as we talked about at the beginning, that was the big thing for choosing these because it literally allows for those different exit strategies.
Yeah. So this particular project, if anybody's interested in how they're structured, we do developments, but often do them in conjunction with other people, with investors. And this particular model, we've established a unit trust, and investors come in, they buy units in the trust. In other words, that's how they invest into the project. We raise enough funds from investors to get more than enough equity, because we always play it conservative when we're doing a project with investors. So it's very important. That's why our feasibilities are very conservative.
Yeah.
And we're raising more funds than the financiers said we really need as equity, as a deposit. Once going to be conservative. So we raise those funds from investors in there. And then we go ahead, we manage the whole project right from the beginning, the research, a lot of the research that you've done, tracking down the right site, which you did with one of your contacts.
Yep.
The capital raising side of it, which Hillary and I do mostly Hillary, really. She's the investment manager, I guess, in our organisation. And so we each got core skills and bring it together. Then we'll manage it, get the approvals, get it built, get it sold. And at the end, the investors obviously get their money back, but they get a nice profit. So that's a pretty simple, straightforward, common sort of structure that we use. And it gives investors an opportunity to share in a development, because in this case, we're putting $1.8 million worth of equity on the table. Not everybody has that amount sitting in their bank account.
That's right. Go rifling through the couch cushions.
Yeah, crack the kids' piggy banks. But rather than limit it to those people that happily have $1.8 million, of course, we structure it so that people can come in. It could be a minimum investment. Sometimes it could be 200,000, 250,000, whatever it is. So that's the structure of that one, and we have a sharing arrangement with the investors. So that's how that one came together. So, mate, it's probably time to wind up. But interesting. So we've looked at the different types of commercial. We've had a look at how they vary in terms of the growth, the yield, the research that you do, what's really driving the industrial market. And we know it's very strong and it's going to continue to be that way for quite a while. And then we've had a look at that case study of a real life project that we're doing. So I hope you really enjoyed it. I love talking about it.
Yeah, absolutely. Could talk about this all day.
Well, we actually do. All we do is talk property all day. If we're not talking to each other, then we're talking to our mentoring students and working on their projects or whatever we happen to be doing at the time. So that's where we'll leave it. And next time, Hillary will be back in the chair, and you'll be out there finding the next deal, Aaron.
Yes.
Because we're keen to do another one.
Absolutely.
Okay. Catch you next time.
Okay.
Bye
Bye.
now.